Hello, my name is Roger Upton, and I'm one of the directors here at MS Consultants. And we're here today to talk about your 2012 tax season, what you should be considering doing for your clients for 2012, and what should you be thinking about maybe postponing till 2013 and later. Now that January has come and gone, Congress has given us a new tax act, the American Taxpayers Relief Act of 2012. When you take those 120 pages or so and combine it with the new repair regulations, which are about 350 pages, in the Obama Health Care Act, we have about 600 pages of new tax law that affect both 2012 and 2013. We're going to talk about these acts and how they affect your taxpayers going forward. And once again, you may end up considering postponing some decisions from 2012 to 2013 after we get done talking here. Let's talk about the American Taxpayer Relief Act first. There are several things in this act that we really think are very good for real estate owners and fixed asset owners. What are we talking about? It's really almost retro. The IRS went back and gave us 2 years extensions on 50% bonus, very good thing. Supersizing Section 179 back to the $500,000 limit for the deduction with a $2 million investment limit. Giving us 15-year lives for qualified leasehold improvements, qualified restaurant properties, and qualified retail property. Also remember, for those 3 Qs, the leasehold improvements do qualify for bonus. The other 2 do not. However, all 3 do qualify for $250,000 under the Section 179 deduction. Lastly, the IRS extended Section 45L, which is a $2,000 credit for building energy efficient homes. We at MS Consultants like this quite a bit because when the IRS means homes, they also mean single apartments. So if you get an apartment builder who builds, let's say, a 150 unit complex, there's a very good chance that maybe 100 units or more of his apartment complex could qualify for this $2,000 credit. 100 units times $2,000 means $200,000 and a very happy taxpayer. If you have situations like this, please give us a call. We'll tell you more about what we can do to help your client receive these benefits. So once again, there's 4 things we like quite a bit under this new act. Now, the one thing we don't like about this new act is the fact that tax rates are going up in 2013. Starting at $450,000 for married filing joint, the tax rate's going from 35% to 39.6%. And dividend rates and capital gain rates are also going up about 5% each. However, that's not the only tax rate increases we're going to see in 2013. So I'm going to talk about that area first. The one that you saw once again so much in the press is the increase starting at $450,000 of taxable income. However, starting in 2013, the first tax increase we really will see will be at $250,000 of adjusted gross income, which means your income before itemized deductions and personal exemptions. What are we talking about? The Obamacare 3.8% surtax. Now, we all know that, that's going to apply to interest and dividends and capital gains. However, it's also going to apply to some real estate professionals, and we're going to talk about that in another segment here in a minute. And so therefore, you could have clients facing a 3.8% tax much sooner than you would expect. The next level of increase we have starts at $350,000 of adjusted gross income. That's where itemized deductions and personal exemptions will begin to phase out. We put a value of that about 1.2% tax. So if you have a taxpayer whose whose taxable income exceeds $450,000, and they're in all the wrong situations here that we just covered, their tax rate going forward is not 39.6. Their tax rate going forward is actually 44.8%, almost a 10% increase over the prior year. And so therefore, when we're talking about all these other changes that are now allowed under the American Taxpayer Relief Act, we may want to consider postponing some of those or electing not to take advantage of those during 2012, knowing our client might be in a higher tax bracket in 2013. So there are two things you're going to hear me say over and over today. The two best things you can do during this upcoming tax season is A, go on extension, and B, do tax planning for your clients so you know what 2013 and maybe 2014 are going to look like. Because once again, you could be talking about a swing of up to 10% tax rates between the 2 years. When you consider all those tax increases, let's talk about the ones that have to do with the depreciation first. 50% bonus and Section 179 up to $500,000 are huge deductions that your clients can take advantage of in 2012. But what happens if you know if next year's tax rates in 2013 and going forward are going to be higher? What's the best choice for your client? Well, we've run analysis several different ways considering this. And in a nutshell, what we would recommend is this. If you have clients with 5-year assets, 7-year assets, 3-year assets, do not take, and you expect 2013 to be a higher tax year, do not take bonus depreciation this year. It'll be more valuable to your clients going forward if they're going to be at a higher tax rate. Now with 15-year assets, which you can take under bonus depreciation for land improvements, and under Section 179 for your 3 Qs, we mentioned that before, qualified leasehold, qualified retail, and qualified restaurant property, it's all right to take that during 2012. Why? The 15-year life is so long that you can recover your tax savings that you make in 2012 over a longer period of time. So that's what we would recommend regarding the depreciation law changes. Now let's talk about the new repair regulations. Once again, the IRS has given us a benefit there. They're giving us up to now to 2014 to implement these changes. They just think the taxpayers need that much more time to figure out how to get their books and records in shape. However, the IRS is also telling us if we choose to, we can implement these changes in 2012 and 2013. Once again, the taxpayer's choice. The IRS also told us that right now we're operating under temporary regulations. The IRS also has told us that they're going to put final regulations in place hopefully by this summer. So knowing all these different pieces of information, what do we do in 2012? Well, the first thing, once again, I would say is let's go on extension so we know, we know how to make our, when we are making our decisions, we probably will have the final regs that we've read and gone through and studied to figure out what makes sense to do in 2012 versus the future. Knowing that, one regulation I'm telling my clients they need to take a look at is the Routine Maintenance Safe Harbor Act. It's not an act, it's just a regulation change. What does this law change have to do with? The IRS says if you have this election in place, routine maintenance work that you do to your property, how do they define that? That's incurring expenses more than once during the depreciable life of your asset will be considered a repair. What's a good example of that? Let's say you own a fleet of vehicles, and over the 5-year life of the vehicles, you expect to have to change your tires more than once, and you expect to change your brake pads more than once in the future. Those items, if you have your routine maintenance safe harbor election in place, will automatically be considered repairs. You don't have to go through all the other tests to see if they have to be capitalized or not. That's a good thing. Another tax law change under the repair regs is the one that's going to allow us to write off retired structural components of a building. Your old roofs, your old heating and air conditioning systems. That's reversing about 30 years of tax law when the IRS is allowing us to do that now. However, if you're going to be looking to do that, I would do two things. First of all, A, wait for the final regulations, because the IRS did say they are looking to change that part of the law. And second of all, once again, measure what your 2012 tax rate looks like versus 2013. I currently have a client where we're getting about an $800,000 write-off of some old assets off their books, but we're purposely going to wait to 2013 because we know the taxpayer is going to be above $450,000 of taxable income next year. More bang for the buck. The other question I've been getting from a lot of accounting firms is what to do about the General Asset Account Election, the GAA, one of the more controversial areas of the tax law change regarding new repair regulations. Well, once again, wait for their final regs. The IRS says they're going to try dealing with this area, hopefully going to make it easier for taxpayers to implement it going forward. So what would I do during 2012? A, go on extension for that. B, if I have a new building this year put in place, I would just check, I believe it's box or line 18 on the 4562, make the election for the new building. As far as your old buildings, I would not make any late GAA elections in 2012. I don't think you're going to hurt your client at all by waiting to 2013 or for the final regs to come out to give us more guidance in that area. Lastly, let's talk about Obama Health Care Act. If you went to any tax training this past fall, most of the speakers got up there and said, if your client is a real estate professional for IRS purposes, they will probably be exempt from the surtax, the 3.8% surtax on the rental income, starting in 2013. Unfortunately, the IRS issued some temporary regulations in December, this past December, and in those regulations, they said that the definition of a real estate professional for surtax is not the same as it is for the income tax law. And in fact, in an AICPA luncheon this past December, the IRS said that in a speech, that is definitely a fact. They're not the same definitions. Under the surtax, the IRS is going to look at each activity, and each activity has to rise to the level of a trade or business. For income tax purposes, you don't have to have that as a real estate professional. So you can see there could be a very big difference between the two. What's a good example of that? I have a client, he has a retail strip plaza, and in front of that plaza he has a fast food restaurant, and that fast food restaurant sits on a land lease. He collects rent from that property, and all his expenses he has against it are a little bit of depreciation and interest expense. Triple net lease type of idea. Definitely would not be considered a trade or activity, and therefore that income from that property might be subject to the surtax. So once again, as we wait for more guidance this upcoming summer regarding the surtax, be prepared to really have to take a look at your clients who are real estate professionals for income tax purposes and maybe determine which activities within their grouping might be subject to the surtax. Once again, another increase that we're looking at for 2013. So how do we surmise everything that we just gone through today? Pretty simple, I think. Go on extension for 2012. Get a real good feel for what 2013 income looks like. Try to get even an idea what maybe 2014 income could look like going forward. Wait for more guidance from the IRS. Then apply elections to your client so you get the best answer for them over several years of taxes rather than just try to get the best answer for them in 2012. Thank you very much for listening in. Once again, my name is Roger Upton, and if you have any questions about today's talk, please feel free to send those questions to info@costsegs.com. Thank you very much.